Welcome to the Let's Get Entrepreneurial podcast, your go-to resource for navigating the world of entrepreneurship.
In today's episode, we delve into the world of investor strategy in entrepreneurship. Whether you're just starting out or looking to expand, understanding how to effectively attract and engage with investors is pivotal.
If you're looking to ignite your entrepreneurial spirit and transform your ideas into action, we invite you to follow our podcast.
The Let's Get Entrepreneurial podcast is your ultimate launchpad for igniting ideas and skyrocketing your entrepreneurial dreams. Tune in, buckle up, and let's unleash the entrepreneurial spirit within. Your two hosts will be Professor Gary Palin and serial entrepreneur Ryan Budden.
Hello, Ryan. How are you doing?
I'm doing brilliantly. What about you, Professor Palin?
Doing very well. I understand you've got a busy day in front of you.
I certainly do. A big on-site with a client that we're introducing to the development team, so it's exciting days over here.
All right. Well, let's do this episode and we'll let you get back to the real world.
There we go.
Today, we wanted to talk about investor strategy. Now, we've covered investor components in different angles, but this is specifically truly understanding the investors and the strategies with approaching them and negotiating, et cetera.
It's good to dive more deeply into this topic. As you said, we've approached it in a couple different ways through different podcasts. We'll take this opportunity to really flesh it out for people.
Assuming that bootstrapping is not a viable component for you, that you need financing, and I would recommend anyone that hasn't listened to our bootstrap episode to go back and review that to see if you really need investment. But let's assume you've done that and you need financial investment for whatever reason. There's two basic types of investors you will typically be using, and then there's two that typically we don't see startups, if ever, using them as more developed ventures, but we'll touch on those also. So the two that typically you see are angel investors, which are private investors. They're investing basically their own funds, and venture capitalists, which they pull together a venture capital pool. The other two are private equity firms and strategic investors. We'll touch on those. Strategic investors, for someone who's not familiar with it, is very often a major company will invest in a startup. Usually it's a pre-acquisition type of deal. With angel investors, probably the most common, their expectations are they like to have a personal connection. There's very often a passion. They like to see, because it's an early investment typically, they like to see the potential for high returns, and they like a heavy involvement in the venture.
This is a wealthy individual that really wants to deploy their capital in a creative way. And they're typically the ones that lead into this. I would say another typical thing of these angel investors is experience in the industry. So if you're in healthcare, these people are typically retired healthcare executives. If you're in the music industry, they've typically had a career in music. I don't often see, and I'm not saying it never happens, people investing in industries that they don't have a very close familiarity with.
Warren Buffett, one of his major theories in investments, he never invests in a company that he doesn't understand.
That's a pretty good one.
Someone that has experience, not just the experience, but the connections in the industry are a major benefit. That's one of the things I look for. It's not an absolute requirement, but definitely it's icing on the cake.
A lot of times they can be a very strategic investor, right? They can bring you into a lot of rooms through their experience in that industry or make connections for you.
The investment criteria for angel investors, usually it's early stage potential. So they are one of the first, if not the first, to get in external outside of your family, friends, and fools. And with that, because it's a higher risk, you're usually giving a serious equity stake with those angel investors. And the terms can vary widely. It's very negotiable.
The terms can be huge. And not only are you giving them an equity stake, as you put it earlier, typically their involvement, maybe not day to day, but definitely week to week, is a lot higher than other investors.
Angel investors, usually their investment is lower than the barriers for a venture capitalist. You might get an angel investor $25,000, $50,000. You'll see them on the high end, but typically you're not seeing them in the $1 million, $2 million, though it can happen.
It definitely can happen, but you're right. That's a rarity. They're coming in with that first money to get viability for the company.
If you need quite a serious infusion of capital and you set your minimum too low, say at 25K, be careful of not having 10, 15, 20 angel investors because your full-time job would be managing the angel investors.
You definitely don't want to get stuck in that position.
With venture capitalists, they will typically have a much higher dollar amount, lower threshold. Used to be typically around $1 million, but it can creep up to $2 million and up. It's not their money. What they've done is they've accumulated a venture fund from either wealthy investors or institutional investors. Their job is to invest that and provide a return to those that invested in their fund. They have a responsibility to someone else. Or an angel investor, it's their money.
I'll add another caveat to the angel investor group before we totally move on, and that's the advent of angel groups. I'm seeing this a lot more in the investment world, where instead of dealing with one single angel investor, so an individual, again, investing their own money, a lot of these people are coming together so that they can get a higher access to investable ideas or investable companies. And they're calling themselves angel groups. It's an informal investment fund, if you will, where they get to hear pitches, hear the ideas, and make investment decisions together and often collaborate on those investments.
With the venture capitalists, they very much want scalable business models. They don't want incremental growth. They're looking for a return on their investment within a specific period of time because, again, they're answering to other people that have invested in the fund, and the patience tends not to be as long.
And their reporting is high. They have to prove a track record. It's not investing your own capital. You're hoping for a return on a schedule, of course, but they actually are responsible for KPIs. How much did they invest? What was the return? And what is the exact timeline that took place over?
And they also would like to see an experienced management team in the companies that they're investing in. And if you're a nascent entrepreneur looking at venture capitalists, you're the CEO or president of the company, you ultimately may get replaced by someone with more experience from their group of people they've dealt with over years.
I've never dealt with that personally, but you do hear and see that happening quite often, where the founding team will get phased out and a more mature team will get put in, somebody that's done that type of operation over and over again.
But that's usually good news because that means you're very, very successful and you still have equity in the company. So you're bringing more experienced people. And it's the theory of, would you rather have a large piece of a small pie or a small piece of a very large pie? That's the theory behind that. So it's good news if you get replaced.
And there are plenty of stories out there of your job role changing for the better. Instead of being the person on the chopping block, the CEO, you're often moved into the head visionary role, or a role where your long-term vision for the company is now your focus, and the day-to-day operations get handed to somebody that's done it before.
And also with venture capitalists, they want a very serious exit strategy where angels like exit strategies, but it's not as hyper-focused as with VCs. They want to know when they're getting their money back.
Yes, on an exact timeline often.
Their investment criteria are the growth potential, they make significant investments, and there's usually a very detailed governance structure in their terms.
And oftentimes they are available for further investments as well. So there's somebody to keep in mind that this is going to be a long-term relationship quite often and not a short-term burn and churn strategy.
The other two, private equity firms and strategic investors, we'll just touch on them quickly because it's not very applicable to most of our audience from my gathering of our interactions. Private equity firms, they're almost acting like a very sophisticated investment banker.
And oftentimes they do fulfill that role for the fund. They are the investment banker, per se, for the fund that they're representing.
And they're not going to get involved in startups. They want to see proven revenue streams. They want to see potential for improvement. So you should have a very serious track record of growth, but you also want to show them how that's going to keep that trajectory growing forward, not to move flat. They tend to look in the longer investment horizon.
They also want a much more detailed, and this is not to say that the other investors don't, but a much more detailed how this money is going to get spent strategy. Upgrading a piece of equipment that has a very definite purpose, or increasing a sales team by this exact number of people, and maybe even the salary ranges they're going to go into.
You also understand that very often you're going to give a very significant equity stake when you're going to a private equity firm. This is not in small single-digit percentages.
Yes, oftentimes, as well as some control of the company, whether that actual equity stake comes along with it or whether it's a board seat, something along those lines.
There's definitely active management. And at that time, a lot of entrepreneurs are uncomfortable because you're moving from more of an entrepreneurial venture to more of a corporate structure.
You probably are. That's a good way of putting it.
A lot of entrepreneurs that are uncomfortable with that and they would like to exit at that point, which is fine because you still own your equity. So you're getting your return at that point.
For those who aspire to go higher in their entrepreneurial journey, we've got something just for you coming up next.
Are you ready to unlock your entrepreneurial potential? Introducing the Janus Entrepreneurial Report, your personalized roadmap to success. In just minutes, discover your unique strengths and areas for growth. Whether you're a seasoned business pro or just starting out, the Janus Entrepreneurial Report will help you identify and leverage your entrepreneurial tendencies. Don't wait, visit Prospirit.com and start your journey to success today.
Now, let's dive back into our journey of entrepreneurial insights.
Strategic investors are somewhat rare, but if you have, say, a major customer that's utilizing your firms, very often they will invest in your company to help with the growth. There has to be a strategic fit. It's usually a long-term partnership, and there's integration opportunities.
That is typically where I see it, is it's vertical integration. So it's somebody that you're supplying, getting supplies from, that you're really closely tied into, and they see the opportunity. So this is typically brought up organically in the course of business, and a lot less going out and seeking these opportunities.
And there definitely has to be an alignment with the core business, with the strategic investor and the company they're investing in.
Without a doubt, you're going to be not only investing in that company, but continuing to work with them on a daily or weekly or monthly basis.
Preparing for an investment is something I wanted to talk about. You have to understand valuation. If you're not familiar with valuation of companies, I would do a deep dive in research, understanding valuations, and or bring in someone with experience that can help guide you through that valuation if it's the first time around.
Understanding that is a good way to not get ripped off. Not saying that anybody's out there to rip you off, but just having an understanding is a great litmus test for what a good deal is, an okay deal is, and a great deal is.
There's so many nuances on that. If you're a newbie, if you will, those nuances can go right over your head. That could be disaster down the road. Also, you want to be very cognizant of having a very compelling elevator pitch when you're preparing for the investors, and you want to have a very robust, strong business model.
Without a doubt, and to be able to show that business model so it documented somewhere, not only in your head where you know how the systems and processes work, but actually written down and can be communicated very clearly.
Very often the pitch deck is sent to the investors before you ever get a chance to meet with them.
That's the opening line. That's the digital elevator pitch, because I know we've done an episode on elevator pitches.
Approaching investors, you have to understand the due diligence process. So understand they're going to be doing due diligence on you, but you should do it on them. Do a deep dive into who these people are that you're approaching before you approach them. You want to make sure you're targeting the correct investors. For example, if there's a venture firm that doesn't touch early stage ventures, well, you're wasting your time connecting with them because they are not going to invest in you. Do research on them on what type of investments. Some just do technology. Some deal just in healthcare. Understand what their history is.
I see that as a huge one, actually, because quite often there are many gatekeepers, if you will, before you actually get to talk to somebody that can make a decision on investing or not investing. And those gatekeepers don't typically answer really any questions. Doing your due diligence on, just as you said, this is a healthcare investor. I'm not in the healthcare industry. This is not a worthwhile conversation. Is really on you. I can't tell you how many startups I've dealt with that have wasted quite a lot of time and effort to get to that first conversation. And it's like slamming the brakes of the car. They're really excited. The energy's out. They feel like they're pitching. And the second their business structure gets laid out, it's, oh, I'm sorry, we don't invest in your industry.
Exactly. We have spoken quite a bit about networking and building relationships as you're developing your business, this is where there really is a payoff. Where cold calling is not impossible with investors, it's much more difficult, or I say it's an easier path if you have your network that can give you an introduction.
It's all about trust. Nobody's going to give you an investment if you haven't built that trust up. And being referred is a very easy way to come in with a little bit of trust already built.
Yes, and in securing the deal, you want to have developed your negotiation tactics and/or bring someone in that has experience with this, because there's a lot of landmines that can be laid out that you're not even aware you're stepping into.
That's exactly right. I've actually had the privilege of doing that for multiple startups as well. When they get to that point, coming in and helping present their technology in a way that can be easily understood by the investor so that we can create clarity on that.
With securing the deal, whether you understand that or not, I would say make sure you have legal representation, someone that has tremendous amount of experience in dealing with the legalities of these structures, and have your own representation. Don't use the venture capital's legal representation.
Right.
The post-investment strategies I want to touch very quickly is managing investor relationships. I had a former student that I was speaking with. He was telling me that was the most difficult part. His thought was he had the quarterly meetings with the investors that had board seats. And he said he spent a month preparing for the meeting and then a month recovering from the meeting, trying to implement what they asked him to do. And he said he had very little time to actually run the business because of this. So you want to get very clear on what the managing relationships are. It's not something you want just to take for granted.
Right. And that goes two ways. You might be the one that's having to do this stressful month before and stressful month after because of implementation and expectations. But you want to make sure that that investor is happy as well, so that they're not the one feeling like they don't know what's going on or you're bombarding them with information. Clarity is key in that process.
An unhappy investor is not a good thing.
No, it's not, especially if you're continuing to grow.
Yes, and if they have a very large equity position, you have a problem.
That's right.
The flip side of that, though, is with post-investment strategies, if you've identified your investors properly that have domain expertise, leverage that investor expertise. Don't be afraid to use that, because that's one of the big assets that they bring to the table. So utilize that after the fact, after the deal is done.
Oftentimes, that's the reason that you should be picking your investors, is because they have that expertise and you're able to leverage their years of experience or their network or their expertise in what you're doing. That should be a serious criteria you're considering before you get to the point where you're thinking about can you leverage it or not.
Are there any final thoughts you have before we wrap up regarding investor strategies?
I have one very clear final thought, and I say this from a point of view where I didn't take this seriously early on in my career, and not that I regret it, but it definitely made a difficult time for me. And that is, when you're in the place that you're seeking money, it seems like there's no money out there and that you need to grasp at whatever is available. And I will tell you from experience that there is plenty of money out there, and it is far more important where it comes from than how much comes in. It's more important who gives it to you than how much they're giving.
Yeah, I recall when you were in college having this conversation with you, and I defined it as there is good money and there is bad money. That is a concept that's very foreign to people, but bad money is coming from someone that is not a good investor. They're going to be very problematic, and it could be the demise of your business if you take money from the wrong person or people.
Without a doubt. Please keep that in mind if you're listening to this.
On that note, let's get entrepreneurial.
Let's get entrepreneurial.
As we wrap up another episode of the Let's Get Entrepreneurial podcast, we extend our gratitude for your presence and attention. Your dedication to the entrepreneurial spirit fuels our passion for creating this podcast. Check out profspirit.com to discover resources and courses designed specifically for innovators like you. Stay on the cutting edge by following us on Spotify, Apple Podcast, YouTube, and other platforms as it is released. Until then, keep the entrepreneurial flame burning.